Hello and welcome to Mark's Trading. Today we're going to talk about when does day trading actually make sense? When does it work? Because if you listen to some of our other prior videos, you will know that we don't believe there are that many high probability trades that you can make every single day and be profitable trading intraday. So when does day trading actually work? So when I first started to trade, a lot of my trades, I would say 80% were intraday. I would say maybe the other 20-30% was swing trading. Swing trading, ideally 5 to 14 days. I didn't do any trend following. Now, the market dynamics have significantly changed from the early 2000s. Mostly because of high-frequency traders. As JP Morgan did a study a few years ago, I think it was 2017, they said that 60 to 70% of the intraday volume are now quants. Now, quants is a large category, and it's not necessarily all high-frequency traders. A lot more money is being deployed to longer-term quantitative strategies. However, intraday moves are really being exacerbated by some of the high-frequency strategies. We talked about some of these, momentum ignition or stop hunting on just using an ATR, and it's become a lot harder. That's why I do like trend following, because there's less random noise that is built into a longer term trend trade, which will last 50 to 150 days. And plus, a lot of the capital that's being deployed into the larger quantitative trend following systems, you could piggyback on those and you will get those parabolic moves, and that's exactly what we want. But for today, we're just going to talk about what makes sense in terms of an intraday trade. Today, we're talking about 2020. This is kind of where myself and my partners fit. Most of what we do is trend following. I do allocate maybe 10% to swing trading and another 10% to intraday trading. And again, when you have periods of much higher volatility and the VIX is above 25 or 30, day trading can make a lot of sense, or intraday trading when you have a lot more volatility. But when the markets are trending up and just grinding up over a longer period of time, like a 2019, there's less and less opportunity, and that's why trend following, you have to change up your duration or slightly some of your strategy depending on what's happening, because not all strategies will work in all markets. All right, so what you might have heard us say before, intraday signals are not extremely robust when using technicals, and that's because the lack of data, because you're only looking at intraday data, and intraday moves are going to be much more random. So when you have a much larger data set, like trend following, going back 30, 60, maybe 90, 200 days even, the more data you have, the more robust the signal will be. So that's really the initial reason why it's hard to day trade if you're trading on technicals, because the intraday signals on a technical level are not robust. The next reason is really more emotional, and it's because traders that are trading for a living are watching their P&L, and when you have zero capital at work and you're not making enough money to pay your bills, sometimes you feel compelled to place a trade to try to generate some type of return to pay your bills. So that is really the second reason. And then lastly is the catalyst. What event is happening that day that you should be making a trade? So for example, every single trader that's trading for a living should have a playbook several hours before the market opens, maybe even the night before. Let's say we know that the Fed's going to be speaking the next day and it's a big Fed meeting. Well, we need to outline what potentially will move the markets up or down based on what the Fed's going to say, or maybe there's a big jobs number. You need to write that out, and you need to know what sectors and what stocks are going to be specifically impacted by those numbers. So let's take a specific look at a catalyst that recently happened. All right, so November 9th, which was a Monday, 2020, you had a very large catalyst that was a vaccine with a 90% probability success rate from Pfizer. All right, so this was a well-orchestrated trade because everybody, since the onset of the pandemic of COVID, has been writing out what their playbook was going to be as the pandemic got worse and worse. So this was a little easier because, in theory, you would have risk on equities going higher, but not all equities, because number one, yields were jumping, which would affect certain sectors obviously more than others. Bonds got crushed, gold was selling off. So what sectors were going to do really well? Well, financials lagged significantly. Why? Credit quality deteriorated. Loan loss reserves increased because people lost their jobs, and interest rates went to almost zero because of the Fed quantitative easing. So in theory, we would say that financials would have done the best. And I think they were one of the leading sectors for that day, if not the best. Now, what would have done poorly? Well, it would have been the stay-at-home stocks. Why? Because they significantly took advantage and had the wind at their back during the pandemic. Why? Because cloud computing increased significantly and revenue jumped. You had processing power that or microchips, semiconductors, because more stay-at-home workers. And so those names had a huge pull forward in revenue. And if everybody's going back to work, what was going to happen? Well, technology and the NASDAQ were going to get hit hard significantly. Plus, additionally, interest rates popped significantly. So high multiple names are going to see a significant headwind as rates start to increase significantly. So we need to have some type of theory in terms of a day trade and why we're going to put it on. This just happened to be a very good intraday trading period for, or having at least that catalyst for intraday trading. All right, so let's take an example of a stay-at-home stock. No real opinion long-term on Peloton, but it was a stay-at-home stock that had significant increase of a pull forward in revenue because no one could go to the gym. People were, the gyms were closed and they were at home. So the stock, I think, more than almost doubled over that period. Now, what I'm looking at here is the Keltner channel. Many of you will use Bollinger Bands. I don't like Bollinger Bands because they're full of volatility, and they're very whippy. And so what I have here is the Keltner channel that is really a derivative of the average true range over a look-back period. And so I set it at about 2.5 standard deviations. And what we have here is the gray line, and that's about 2.5 standard deviations above the mean. And then the green line is 2.5 standard deviations below the mean. Now, if we had this on our radar, the stock fell 20% actually right at the open as the vaccine was announced. So on an intraday basis, we can sit here and say, well, that's a little overdone, but how do we know what overdone is? Well, 2.5 standard deviations below the mean on a 40-day look back. I'm using a 40. You could use 100. You could use 50. You could use 20. At the end of the day, it's not going to matter. You can't curve fit it. You can't have the exact specs. And what I suggest is don't try to curve fit it with what works the best in the past. Just stick to something and follow it. It's just a tool. So when the stock basically hit almost 2.5 standard deviations below its mean, you could have said, look, it's down 20%. I'm going to take a short-term long trade as a potential bounce. And that is essentially how you maybe would want to pick up this trade as a long opportunity that was sold off intraday. Now, on the flip side, what we have here is JP Morgan. a name that significantly moved higher, and a sector that moved higher that day. Why? Again, because interest rates were popping, credit quality presumably was going to get better in the foreseeable future now that people are going to go back to work and be able to pay for their loans. But what we have here is the stock broke out on its ATR, the average true range stop, which turned into a buy, and then just blew out. But how do we get back into this? If we think that this is going to be a longer-term sustainable trade, well, what I would have done is look for the stock to back and fill a little bit into its average true range. And you had a couple opportunities right in here, and then again right here you tested it and then you bounced back off of it. So you could have picked yourself up maybe $6 or $7 by doing that. Now, what I do is I'm using an hourly chart here. It doesn't matter if it's a daily, an hourly, 30 minutes, 4 hours. Pick something that you feel has a wide enough range for that day. This is a very large move, so I'm using an hourly. It just fit well. The half an hour didn't, and the daily didn't as well. So anyway, this is how you could potentially buy some strength into a big well, it's not necessarily a big pullback. It was maybe about a 3% pullback at this point on a very, very bullish catalyst that the market has been waiting for. All right, so lastly, what's the bottom line here? The bottom line is I don't think just technicals alone will allow you to be highly successful day in and day out without an event-driven catalyst coupled with that. And not every day will you have a high or a big enough, let's say, event-driven catalyst that you can trade. So don't force an intraday trade. Break up your time frames from trend following to swing trading and intraday trading. And I think this will help you become a better trader. See you on our next video.